Yeah, cool.
Hello and welcome to today's webinar, Thinking of Selling Your Business. Thank you for joining this session today, where we aim to provide you with useful hints and tips that will assist you with selling your business when the time is right. We'd love to hear from you during today's presentations. If you have a question for our speakers, please feel free to send it through the Q&A tab at the top right of your screen. This can be submitted anonymously if you would prefer to do so. We'll be answering questions at the end of the session, but if we don't get to your question during today's webinar, we will be sure to follow it up afterwards. So I'd now like to kick things off by welcoming Paul Hebburn from Jerram's Corporate Finance. Paul, over to you.
Thanks, and welcome everybody to this morning's webinar. Appreciate you you all dialing in, taking the time to take a listen. We're going to run through the process of some high-level hints and tips really on selling your business and what the process might look like and how it might be engaged. We should be running through the how we run through the broad process itself. We're going to look at the tax implications, and then finally, when the loot and the reward is all in your sticky mitts, we'll be into looking at what wealth management considerations and how you might be thinking in advance as to how you plan to deal with the proceeds. Jerram's, as you're probably aware, is an organisation that offers services across that spectrum, and that part of the offer that we engage with our clients that are looking to sell their business. Now, if you are thinking of selling your business, I mean, there are certain things that can be done in advance. The process itself is quite time consuming, and it has to be said in some ways emotional. And so really what I'm going to do is kind of pick off some of the kind of headline issues that you're likely to encounter. We're going to make sure that you understand, you know, what things can be done in advance, how one might go about optimizing the value of your business, the process of screening and identifying targets, looking at potential buyers and how we engage, getting the heads of terms right, the process of managing the sale process itself and the due diligence process, and obviously, as previously mentioned, the tax implications, the and maybe a little bit of the kind of hints and tips around things that can get in the way, processes that can make the whole kind of thing more complicated or more difficult than it should reasonably be. So without further ado, really, I'm going to get into the key pillars of the process. Now, there's a lot of stuff on that slide. I'm not going to kind of cover each box in individual detail. We'd never have time on this morning's webinar, but I am going to cover each of the four key pillars of the process, really from the outset, how the project gets initially engaged. We're going to look at the sales mandate process itself, how we get into the final agreement and the negotiation of heads of terms, and then what would be probably collectively referred to as the completion process, which is the fourth pillar. Now, suffice to say that there is a kind of structure, a process, a norm through which these things are done. I mean, clearly they're all bespoke in the sense that each deal is unique, and the value drivers and who the potential buyers might be and the kind of things they'll be looking for are all unique. But the process itself is one that's been trodden, a path that's been trodden many times before, and we have at the team here at Jerram's, we have a tremendous amount of experience with that process. So jumping straight into the first pillar of that process, which is to, if you like, the initiation of the project. I mean, clearly we're looking there at understanding the vendor's objectives. Now, that may sound rather simplistic. All I want is to get the best possible price and the most money conceivable for my business, but it's generally more complicated than that, and there'll be People that are looking to sell to family members. Maybe there'll be people looking to sell a share of their business to other shareholders. There may be implications of selling to the management team, or there may be friends or colleagues that you're looking to sell to as a potential buyout. So understanding the broad objectives, are you looking to sell out 100%? Are you looking to retain a small percentage of the business after the event, maybe to continue to be involved or engaged even for a period after the event? So understanding the objectives of the sale is very much a key part of the initial step into the process. There's a lot of research to be done, which is very much on our part, and that's not just to understand the business better, but to understand who the potential buyers might be, who your competitors are, what comparable transactions there are in the marketplace, which will be key indicators of value. We need to, early in the process, or reasonably early in the process, set out our thoughts to you on what the valuation might look like, and what kind of structure you might expect in terms of upfront consideration and maybe some element of deferred consideration. And clearly there's an opportunity to be looking at that from a taxation perspective as well. And just to pause there for a moment, it's probably worth noting that, because there are a number of sales brokers out in the market, and one of the things that distinguishes them is very often they do not provide taxation advisory services as part of what they do. It is important to identify that actually, as part of Jerome's, we do provide a kind of taxation advisory service as well. I note there that there's going to be probably an A and a B list, and in some cases a C list prepared of potential buyers. Just to explain that momentarily, the A list is the kind of obvious candidates, people that are already in your market, people who are likely to be looking to grow their capacity, to grow their footprint in the market. The B list is almost always going to be made up of people that we will know, and it's most unlikely that you do, and they come from a segment of the community that are known as private equity investors. These are people who are looking to buy and build groups with complementary businesses, so they're financial buyers, if you will. And there was a time when, if there were trade buyers in the market, they'd tend to outbid private equity buyers. That's no longer true, and certainly we're seeing evidence even in the past, even in the past few months, but definitely over the past 12 months, of private equity buyers sometimes offering the best prices in the market. And certainly if you're looking to potentially roll over some of your equity and stay with some stake in the business, then private equity might even be the preferred route. The C list, if we get there, is a bit more contrived. It's people that we think might be looking to move into your market sector. So it's from parallel vertical markets where our research indicates that they might be interested in acquiring a business that's in your sector. So those are the kind of key items on the kind of, if you like, preparedness list. Once we've initiated the sales mandate process, again, a kind of just boring but technical point is we prepare effectively 3 documents, albeit one of them you could argue is a kind of template, which is the confidentiality agreement. But we prepare a full-blown information memorandum, which is a kind of brochure on your business, really, tries to tease out some of the key highlights. It's not an overtly or exclusively sales document. So if there are negative things, if there are complexities or issues or challenges, we'll tend to make note of them in the IM. If no other reason, then there's no point in, procuring a valuation. That they'll come out later. So we might as well, be a little bit kind of candid in the IM. But it is nonetheless a sales document, so it is going to focus more on the positives perhaps than the negatives. And then, having put all that effort and energy into creating this information memorandum, we're actually going to pretty much ignore it and produce something that is a cut down version called a taster document or a taster letter. And this is what we use. It's an anonymized document. It won't tell who the potential buyers are, who you are, but it will give them some key highlights, and it is what we use to initially engage their interest. So they'll receive a copy of the taster. If they're interested, they'll sign a confidentiality undertaking, and only when they've signed that confidentiality undertaking do they then receive the full-blown IM. Now, this is very much a kind of our part of the process. So at this stage, we are engaging with you to answer any questions we don't already have the details answers to, but by and large we're trying to get to a shortlist here of people who are serious, that are making offers that are in the right ballpark, to enable you then to select the preferred candidate, the preferred buyer. So at this stage we are dealing with them. We'll try and keep you out of it if possible. We'll try not to get you at least sucked in for too much time and effort, and really, in an ideal scenario, we are driving the timetable so that the potential buyers at this stage give some indication of their intentions, what their deal structure might look like, how they're going to fund it, and so forth. Really, before we get to the stage of sitting down with you and saying, right, here's the 4, 5, 3, 6, whatever it is, potential bidders. These are the kind of structures of the deals that they're indicating they'd be minded to go ahead with, and then we're working with you then to try and shortlist that down. That comes into the third pillar, where we're working with you on a shortlist. That will almost certainly involve a meeting with the vendors, maybe also, if you're not the manager of the business or the key managers, there may be at least a discussion about whether or not we get them involved at this stage. I've said here managing an auction process. Can't guarantee that happens every time, but clearly the best way of securing or giving you the confidence that the valuation in the business is the one that you're you were hoping for, or is the best that's available, is to try and get involved into some kind of an auction process. For that to happen, clearly we need 2 or 3, 2 or more bidders in the process. It isn't impossible to conduct an auction with only one bidder, but we'll maybe take that offline and explain to you how that happens. But certainly at this stage, we're trying to make sure that they're being honest, and they're putting all of their kind of cards on the table, if you will. And then we're sitting down with you to evaluate the detailed offer terms and agree the heads of terms. Now, the heads of terms is kind of one block down there. That's actually a process that can take maybe up to a week and a half itself. And that's simply because at Jerome's and our experience of doing these transactions is that as much detail as possible needs to be packed into the heads of terms. Any of you on the webinar who've had experience previously of dealing with lawyers will know that if there is scope for disagreement, then that scope will get will become exploited during the next stage of the process. So heads of terms will appear quite detailed. There'll be quite a lot of trivial stuff in there, what their intentions are with the property, what their intentions are with senior management, if they're asking you to stay on for 6 months, how much they intend to pay you per month, and this kind of thing. And why do we get to that level? It's simply to avoid costly and, more importantly, lengthy legal disagreements that might occur at the next stage if that's not done. And then we really are into the completion process. Now, from signing of heads of terms, this process will probably never take less than about 6 weeks, and can easily take between 8 and 12. And this will involve the buyer then conducting their due diligence. It may seem silly that they've made an offer without completing their due diligence, but it's kind of the other way around, really. Unless they know they've got a deal in principle, they won't really throw external resources and huge cost at the process to get themselves their heads around any complexities of the business. Scope of due diligence always, pretty much always anyway, involves legal and financial due diligence. So there'll almost always be external lawyers, and there may be, and there will I say maybe, there generally is external accountants that are engaged by the buyer to look at the business. Can extend into other areas. I've known due diligence go into, looking at key customers and suppliers and doing some research on them, some cases even visiting them. We do work on the other side of the table, so we sometimes work with buyers, and we carry out this due diligence process, at least the financial, and we've certainly done, vendor and supplier due diligence. We've looked at supply chain issues. I have known there be psychometric profiling of senior management done, that kind of thing. It's rare, these things don't happen all the time, but scope is agreed fairly early on, usually at heads of terms, and our job becomes one of kind of captain timetable really now, managing the process, bullying people to do their job and get stuff done. Around about halfway through that process, as long as the due diligence is progressing as we would anticipate, then they'll start to get heavy on the engagement of their lawyers, and we'll get into the drafting of the final legal agreement, which is either a share purchase agreement or an asset purchase agreement. And Nick, when he goes into the tax implications of the deal next, will cover off the differences between those two. And that's the final run into the process. Once those are done, and a few documents that wrap around those, including the disclosure letter and in certain cases service agreements, then we're into the final running, and the process is complete. So a bit heavy, forgive me for the content, and we can obviously deal with any specific questions on any of those tombstones later on, but fundamentally that is the process for selling your business from a CF advisory perspective. I'm going to pass over now to my colleague Nick Wright, and Nick's going to talk you through some of the tax implications. Nick?
Thank you very much. I don't know if Sharon's made you aware, I've had a few technical issues this morning, so hopefully everyone can hear me. And apologies to Sharon if I've given you a minor heart attack getting on. So yeah, I'll be talking you through some of the tax implications of selling your business. The large part of this presentation is really looking at selling your business to a third party, so mainly looking at what the tax advantages of selling the shares in your company versus the sale of a trade and assets. I will end the presentation with looking at a few other options in terms of management buyouts and that kind of thing, and obviously also talk through one of the sort of major headlines in any kind of sale, which is business asset disposal relief, or what used to be called entrepreneurs relief. So if we could have the next slide, please, Paul, and the next one again. Right, so a sale of shares is quite straightforward. A third party or the potential buyer will come along, they'll acquire the shares of the company directly from you, and presumably in 90% of cases or 99% of cases there'll be a gain on the shares. Most of the time the base cost of your shares is the nominal value, certainly if you've started the company from scratch. And so the proceeds that you receive from the buyer, less the costs that you've paid for the shares, will be subject to capital gains tax. In terms of how these are funded, there's obviously various different options. It's not always just going to be a straightforward cash sale. Cash is the simplest in terms of how that's taxed. The cash is received when the contract becomes unconditional, and that's subject to capital gains tax on disposal. Other options in terms of what the buyer might offer you, they might offer you some shares in their business going forward, whether that's preference shares or a minority stake. They might offer you loan notes if they can't fund it all immediately on day one. And under the share for share exchange rules, both for shares, share capital and loan notes, automatically they will be treated as continuing, and there'll be no immediate capital gains implication. Obviously you might be wishing to qualify for business asset disposal relief, and you may not qualify on the disposal of those loan notes or shares in the future. And there is an election you can make to disapply the share for share exchange rules in order to obtain business asset disposal relief up front. If you make that election, you pay the tax now, hopefully at 10%, and then in the future, when you come to receive the proceeds, maybe 2-3 years down the line, there's no tax to pay because you've already paid it. There's also a potential for an earn-out. In a lot of cases, this will happen certainly if the profits of in the future are more target related. So what the buyer might say is, if we've got profits of as long as we hit profits of $1 million, you'll get additional consideration of X. Those are taxed in slightly different ways depending on whether you can ascertain the value of that earn-out now, i.e. it might be as simple as in 12 months time we'll give you £1 million, or it might be unascertainable, where they say in 12 months time we'll give you 10% of the profits that we earn, which obviously you don't know until the date's passed. So ascertainable consideration is tax the entire gain up front, and unascertainable consideration, you still have to tax it up front, but you need to find a value for that future consideration. And once it's received, if the consideration is higher, then you obviously pay tax on the difference. If it's lower, then you'll need to claim a loss and get a refund. If we could have the next slide, please, Paul. Move on to the sale of assets. Generally, this is slightly less efficient for the seller. Obviously, buyers quite like this option because it means they can leave behind any of the unknown liabilities in the company. They don't have the history of the company moving forward, which in a lot of cases might be beneficial for the buyer. What this means, though, is that the company is selling the trade and assets, so the company is paying corporation tax on any gains it makes. So obviously there might be stock in there which you assign a value to, so there's trading income that's subject to corporation tax. Capital allowance balancing charges might apply, and then any capital assets, in particular goodwill or land and buildings, will be subject to chargeable gains, and that's corporation tax. And moving forward into 2023, it's quite likely that a lot of this will be at 25% rather than the current 19% CT rate. Obviously, then you've got a problem with that. You've got funds sitting in the company, and how do you get those funds out? There's various options you could use. You could decide to use that company as a investment vehicle moving forward, but assuming you want the cash, you need to withdraw the funds, and the most obvious way of doing that is via a liquidation. So there'll be fees incurred for paying a liquidator, but the important thing with a liquidation and for the tax efficiency route is that distributions on a liquidation are capital distributions, and therefore you can be paying the 10% business asset disposal relief rate and 20% thereafter. One thing to be aware of, though, with liquidations, there is a targeted anti-avoidance rule, which basically says it's to stop people winding companies up, getting a capital distribution and going off and doing the same thing. So this rule basically says if you do a liquidation, get the capital treatment, but then carry on as you were before, whether that's in a sole trade business or a partnership or another company, then HMRC have the right to convert that into an income distribution at dividend rates. So certainly not ideal, and one to watch if a liquidation is the route you're going down. Next slide, please, Paul. So here we've got an example, just to kind of put some figures on those. So here, a very simple husband and wife company own a single trade co. The value of the trade and assets £1 million. Buyer comes along, acquires the shares in Tradeco. So husband and wife selling 50% each. They're paying £1 million for it. Both are eligible for business asset disposal relief, and therefore after the 10% capital gains tax, they'll retain £900,000. Moving on to a sale of trade and assets. In this case, the buyer comes along, buys the trade and assets directly from the company. Husband and wife are left with TradeCo. So potentially, if there's no base cost for the company, you've got £1 million, as I say, currently at 19%, but that's going to become worse at 25% in April 2023. That means you've only got cash left in the business after the sale of 810,000. You then need to liquidate the company. You'll again be eligible for business asset disposal relief. So on the drawings, you've got 810,000, you pay 81,000, so you're left with £729,000, which is obviously a significantly lower value than you would just by selling the shares directly. So it's definitely something we need to be aware of, and this is the kind of thing that sort of once you've put some numbers on it in the negotiations, you'll then seek to say, well, you know, I'm happy to sell you the trade and assets, but you need to compensate me, and obviously that kind of goes back to Paul's remit of how you negotiate the sale and agree an acceptable price for both buyer and seller. Next slide, please, Paul. Yeah, I think this one's just comparing the difference in the two. So in the example I've just given, selling a company worth £1 million, selling the shares could be better. You could be better off by the tune of £171,000. So there can be very significant differences here, and it's very important you sort of look to get this kind of advice before looking at agreeing heads of terms. So you don't come further down the line and realise actually I'm losing out a lot here. So yeah, it's just something to be very aware of in the initial negotiation stage and how the tax will apply in each circumstance. Next slide, please, Paul. We'll move on to some of the business asset disposal relief conditions, which I've already mentioned a number of times. Sale of shares. As long as you've been a director for 2 years up to the date of disposal, as long as it's been your personal company, that means you've held at least 5% of the share capital, and as long as it's been a trading company, you should qualify for the 10% BADR rate. A trading company in this case is that you hold at least, or the company has activities of at least 80% trading in nature. So there is an element of leeway that you might have some investment activities. If you've got some excess cash, you might be investing, or you've got a rental property. But it's certainly important to be aware that you don't want to taint the trading nature of the company in its entirety and therefore lose out completely on business asset disposal relief. Otherwise, everything's going to be taxed at 20%. Moving on to a sale of trade and assets, the same principal rules apply. However, obviously, once the company has sold its trade and assets, it immediately ceases to be a trading company. So then you'll liquidate maybe 3 months, 2 months down the line, and it hasn't been a trading company for 2 years up to the date of disposal. So there is a further clause in the legislation that says on a liquidation, as long as you've met those conditions up to the cessation of trade and you make a distribution within 3 years of the cessation of trade, then you can still qualify for business asset disposal relief. So yeah, I mean, most of the time you're going to want the cash out as soon as possible, so there's no real issue with that 3-year period, but at least that 3 years gives you time to wind down, because for instance, you might be leaving a property in there that you might want to sell that maybe the buyer didn't want to take on. And just to be aware, in both cases, as of March last year, the lifetime limit for business asset disposal relief was reduced to £1 million, and that's per person. So in my husband and wife example, technically they could have had gains of £1 million each and qualify for 10% on the whole lot. Moving on to some planning opportunities. It may be possible to transfer, again, this needs to be done quite early on, as soon as possible, really. It may be possible to transfer some shares to a spouse. Share transfers to spouses are at no gain, no loss. So there's no capital gains tax implications of doing that now. But in order to claim business asset disposal relief, your spouse would need to meet those conditions, i.e. they would need to own the shares for at least 2 years up to the date of disposal. So if you're thinking you might be looking at selling in the next 2 to 3 years, and you might be able to benefit from your spouse's £1 million lifetime allowance for BADR, then a transfer would be beneficial to get the full value of the BADR £1 million lifetime allowance. It can also work with transferring shares to adult children. We'd need to go through a few more hoops to do that, though, with sort of claiming things like gift relief, because you don't want to incur an immediate capital gains tax charge in order to achieve the planning. But as the slide says there, the most important thing to remember is that if you're doing anything in terms of trying to achieve benefits on BADR, you need this 2-year holding period. Moving on then, so as I said at the start, there's the large proportion of what I've just said was really looking at selling to third parties who might come along and offer a price for your business. You may, one option, if you've got a group of companies, or if you've got more than one trade sitting in the same company, it may be that you think it'll be easier to market the sale of a certain trade if it was in a separate company, or it may be that when the buyer does come along, they say, well, we don't want that subsidiary. I'm working on one now actually where because of FCA rules, the buyer cannot take on one of the subsidiaries because they're FCA regulated, and therefore we need to find a way of getting that subsidiary out of the group before the sale can happen. So a demerger is one of the sort of key options to achieve that. As Paul's already said, there's, in terms of the timeframes of achieving a sale, a demerger will obviously add to that. In terms of doing a demerger, certainly in anticipation of sale, you need to apply for HMRC clearance, but more importantly, we need to be waiting. So to draft a clearance, you're probably looking at a couple of weeks. For HMRC to come back, you're looking at probably 4 weeks if they don't have any questions, and then you need to complete the demerger before you can then sell. So you're looking at least another couple of months on top of the process if a demerger is required. But as I say, it might be if you're starting to think about selling, and either you want to retain one of your businesses to carry on at a lower level, or you want to, or you think it'll be easier to market, then doing that demerger as early as possible is the best advice, really. Also, if you either can't find a third-party buyer, or if you'd prefer your business to carry on through, or you think the management team in the business is perfectly capable of taking it on, then you might look at things like a management buyout, in which case it's subject of a whole nother presentation really, but the management team will essentially buy out the business. Again, that can be funded by external finance. You might accept loan notes so that the management team pay you over the next few years, but that's certainly another consideration if either you prefer it, or if there's an easily identifiable third-party buyer, or a company purchase of own shares, which is if there's other individuals in you shareholders in the business, and you're one of, say, 5, and you want to sell out and let the rest of them carry on, then that's another option. And I think that's coming towards the end of my presentation. If I could just have the next slide. Yep. So I think I can now hand you back to Nick.
Thanks, Nick. We've got a surplus to Nick, so we're bringing on Nick Hathaway now to talk to you about financial planning.
Thanks, Paul. So good morning, everyone. My name's Nick Hathaway, and I'm one of the financial advisors here at Jerem's Financial Planning. I'm going to be talking about some of the financial planning considerations when selling a business. Can I have the next slide, please? So as Nick's already touched on, the reduction to the business asset disposal relief limit from £10 million to £1 million might have an impact on many business owners' plans when selling their business. Just to recap, business asset disposal relief was formerly known as entrepreneurs relief, and allows qualifying businesses to pay a reduced 10% capital gains tax rate on sale proceeds up to the lifetime limit of £1 million. So business owners with companies worth more than £1 million would have to pay 20% capital gains tax, which might not have been expected while they were building that value up within their business, under the assumption that the limit was going to be £10 million. The £1 million limit is a lifetime limit. So if the proceeds for the business you're selling fall below this limit, but the allowance has been used during previous business sales, it won't be available to use for the current business sale. Because of these changes, extracting as much value from the company in a tax efficient way in the years before company sale is more important than it's ever been. I'm just going to briefly touch on some of the main methods of extracting value from companies, which may already be well known to business owners and directors. These topics are relevant throughout the lifetime of a company, and it's not just as you come to sell. So I think so salary benefits from being an allowable business expense. That's the first means of taking value from a company. So it therefore achieves a 19% corporation tax relief. However, you're ultimately going to be liable for employer and employee national insurance, as well as income tax in your hands once it's drawn from the company. It's for this reason that a lot of limited company directors turn to dividends, which have lower income tax rates than salary. And you can also make use of the £2,000 0% dividend allowance. However, again, dividends must be deducted from post-tax profits, so they've suffered 19% corporation tax before they're paid out. So the final method is to build up value within the company and then benefit from the 10% business asset disposal relief tax rates on sale. As I've mentioned, one of the disadvantages of this is that the lifetime limit has been reduced to £1 million from 10 million. And also you're going to be paying corporation tax at 19% as you're building up those profits within the business. So let's just consider a company with £40,000 profit, which you can see on the left-hand side of the slide. To the right of each arrow for each of the methods, you can see an approximate net figure, which would be received with each of these methods after tax and any national insurance is paid. So of that £40,000, somewhere between £9,000 and £12,000 will be lost to some form of deduction. Can I have the next slide, please? So that brings me quite nicely onto a solution to this, which is pension contributions. Paying into a pension isn't often considered by business owners as a way of taking money from a business, but is actually the most tax efficient way you can draw from your business. So of the £40,000 profit we saw on the previous slide, all of that amount will be paid over into a pension with no tax or deduction taken straight away. Pension contributions are a business expense, so they benefit from 19% corporation tax relief. And if the company is going to be affected by the increase to 25% in 2023, these pension contributions become even more beneficial. Any growth within the pension will build up tax-free up to the lifetime allowance of £1,073,100, and up to £40,000 can be paid into a pension each year per individual, with any unused allowance from the previous 3 tax years being able to be carried forward. So this means potentially you could pay up to £160,000 into a pension in one go. So if you've got some of the examples Nick used, a company with a husband and wife, both directors, there's the potential to extract £320,000 via pension contributions in one go, which is £320,000 that's not going to then be liable to corporation tax. A pension contribution fund can be accessed from 55 onwards, and up to 25% of it can be taken tax-free. Another tax advantage of pension funds is that they're held outside of your estate, so they're inheritance tax exempt. Then the final benefit in the bottom corner is the flexibility of pensions, which we'll look at now. If you can just put me onto the next slide, please. So the red box you can see represents the modern pension fund. It's a pot of money accumulated over your lifetime, which has benefited from tax relief on what goes in, which is contributions, and tax-free income and growth while it's building up before you retire. 25% of the fund can be taken tax-free at retirement, which is the column you can see on the left-hand side. and then the remaining 75% will be subject to tax, and it's effectively just added to any other income you have, and then it'll just be subject to normal rates of income tax. Many of our clients find they don't need to take all of their 25% tax-free cash in one go, and so they can use it to generate a very tax-efficient income in retirement, which is what the boxes at the bottom are showing. So you could take up to the personal allowance threshold of £12,570 from the taxable side, and that would be before any income tax is payable. When you take from one side of the pension, you do what's called crystallise an equal proportion from the other side. So that would be £4,190 from the tax-free element in this case. What that means is you're getting an income of £16,760 from the pension with not a penny paid in income tax. If you've got other sources of income, the amount that you take from the pension can be reduced as needed to make use of various allowances and tax bands. So, for example, you might take a small income from a pension fund to top up your state pension just to make sure you're fully using your £12,570 personal allowance, just because if you don't use that allowance, it'll be gone forever at the end of the tax year. The main benefit of modern pensions is the flexibility of them. You can take as little or as much as you want, as regularly or infrequently as you want and need. You've got the option of taking the entire pot as a lump sum, although you'd end up paying quite a lot of tax if you did this. If you've got significant other assets as well, or lots of other sources of income, many of our clients won't even draw on their pension fund. They'll just leave it invested as an inheritance tax friendly fund, which they can then pass on to their loved ones after they're gone. Can I have the next slide, please? Thank you. So another consideration when you're selling a business is inheritance tax and business property relief, which is also known as BPR. So when a company is sold, the sale proceeds will come into the owner's estate, and that can create a liability to inheritance tax, which is chargeable at 40%. Many companies qualify for BPR, which means the shares can benefit from 100% inheritance tax relief. BPR was originally created to stop the need for a family business needing to be broken up or sold to pay inheritance tax when one of the owners died. But more recently, governments have been using it to sort of entice investors into younger and smaller unlisted businesses. So if we consider, for example, a business owner coming to sell a business for £5 million, while he owns the business, he's got no inheritance tax problems as his shares will qualify for BPR. Once the sale is finalised, however, that £5 million will come into his estate and it'll just be taxable like anything else. So if that business owner was to sign the contract agreeing the sale of his business, then walk outside and get hit by a bus, his loved ones would be left with a £2 million inheritance tax bill on that £5 million. That just means it's really important to consider the effect of on your personal tax situation as a result of these sale proceeds coming into your estate. And we'll just look at another example on the next slide, please. So this is Alan. Alan sold his business 2 years ago for £3 million. He invested £2 million to live on to fund his retirement, and wants to leave that remaining £1 million to his daughters when he dies. Because that £1 million falls within his estate, it's liable for inheritance tax at 40%, and that just means that only £600,000 of it's going to be left to his daughters. However, if you were to reinvest the proceeds, the sale proceeds, into a BPR qualifying investment within 3 years of the business sale, that valuable business property relief and 0% IHT would be retained. So this means that Alan could invest that £1 million is earmarked for his daughters into a BPR scheme or investment, and he'd retain that ability to pass that full amount on to his daughters with no IHT to pay on it. It's worth pointing out that BPR investments are typically riskier than mainstream investments because it's a tax relief, that was really designed, as I've said, to encourage investment into smaller companies. So AIM shares and enterprise investment schemes are some examples of a BPR eligible investment. That being said, many BPR investments are structured so that they qualify for the valuable tax relief while at the same time taking on as little risk as possible. So that will be done by investing in businesses which aren't speculative in nature. So they'll be backed by real assets such as lock-up storage, secure lending on commercial property development, and then things like forestry and renewable energy that benefit from tariffs from the government. Next slide then, please, Paul. Thank you. So aside from all the tax considerations, it's really important to consider what to do with the sale proceeds. For many, this might be the biggest sum they've ever had disposable in their lifetime. And assuming you're not immediately going to be reinvesting into a new venture or company, an instinct might be to just hold the sale proceeds in cash, and that there's no risk to this approach. However, holding cash has its own risks due to the effects of inflation. I recently found out a pint of lager cost 14p in the early 1970s, which is very different to the situation today, but demonstrates the effect of inflation over time. So as the article on the left of this slide shows, there are no mainstream accounts that offer interest rates that are beating inflation at the moment. So if you're lucky to get a 1% interest rate, which not many people would be able to, but inflation's running at 2%, your money is declining in value each year due to inflation. So if I presented you with a proposal for a £1 million investment, which I could guarantee would lose you £10,000 every year, I doubt you'd be keen to take it. But that's exactly the conundrum that the current interest rates on cash are presenting investors with. There's even fears as well that inflation could reach 3.5% to 4% over the next 6 to 12 months. Whether that comes to pass, who knows, but that's one of the fears. So now more than ever, investing some or all of your business sale proceeds can be the only means of beating inflation and ensuring that money you've worked long and hard to build up within the business at least retains its value over time. That's where our investment process at Jeremy's Financial Planning can be of great use to clients in this situation. We currently invest over £100 million of clients' money, so it's crucial that how we invest and our investment process is robust and consistent, and something that's been well tested over time. We risk rate all of our clients, and then we use risk rated diversified multi-asset investments, which is a bit of a mouthful. I've not got enough time to go into any of this in detail, but the process is essentially designed to not put all of your eggs in one basket and to spread and reduce the risk associated with investing. We saw the benefit of this approach in action over the last year during 2020, when all of our clients' assets grew in value despite the COVID pandemic and turbulent market conditions. So the blue line on the graph on the right hand side shows our risk profile 6 portfolio. So that's a 6 out of 10 on the risk scale. While that red line below is our benchmark. So that's what we're trying to beat. It's the wider market and our peers. So you'll notice from the figures in the bottom right hand of the slide that we've outperformed this benchmark by around 30% over the past 5 years, which we're really happy with. Then that green line at the bottom, which you'd be forgiven for not even noticing, that's the return on the Bank of England base rate or cash that you might have received. That's probably all I've got time for, but thanks for listening. And if you want to discuss any of what I've mentioned or have any other questions, do feel free to get in touch.
Thanks, Nick. That's great. Apologies for those who were seeing the random advancement of slides. I'm not quite sure why that was happening. I was reversing it as quickly as I could, but anyway. Okay, so we've covered off broadly the subjects that we said we would, which is the process involving sale, how one should build the implications of taxation planning as early as possible really into that process, and it definitely should be an integral part of the process. And then hopefully Nick has touched on some of the options and how one might start thinking about the use of the ill-gotten gains at the end of the process. That leaves us with around about 10 minutes before we close out on the webinar for any questions. And I'm going to call Sharon back in now because hopefully she's been paying attention to the Q&A board, and well, let's see if there's any questions that have been fired at us in the meantime. Sharon? Oh,
hi. Okay, yeah, thank you for submitting your questions. Some of the questions, we're looking through them, that have been submitted have already been addressed. So I'm just going to put forward a few questions. The first one is there anything that I should do to prepare my business for sale?
Probably one for me there. I mean, there's lots generally that can be done, and I think it's very much something we would sit down with you at the early stage. When I say there's lots that can be done, it very much depends. I mean, you're you know, from the simple of making sure that all the things that we know are going to come up during the process are, you know, some thought and consideration is given to them. We build what's called an electronic data room, which, by the way, doesn't get used until later in the stage of the process. But notwithstanding that, it's almost always the bit that if things are going to start to slip on time frame, it's when we come back to you and say, oh, by the way, you know, you've got, I don't know, 10 key customers. Can we see copies of contracts for those 10 key customers? You can only find 9 of them because one's got lost or something in the email system. So there are several things that can be done of a pure practical nature. In terms of the business itself, you know, it's just stripping out the kind of personal elements, really. We're all guilty of this to some degree, but people who own a business, you know, either 100% or with a family interest will very often blur the lines a little between what is business and personal expense and so forth. That kind of stuff needs to be tidied up pre-IM, really. We need to be clearing those things out so that what we're representing to the potential buyer of as the business in the state that it will be, you know, immediately they acquire it. So yeah, there's generally things that can be done, and it's very definitely something we'll touch on during those early meetings.
Okay, thank you. This is one aimed really at Nick Wright, and I think you did cover this in your presentation, Nick, but there might be something you want to add to it. So the scenario is a husband and wife jointly own a limited company, 50% shareholding. Husband is thinking of retiring and would like to sell his shares to his wife. They'd like to know about tax implications and whether they'd qualify for BADR.
The tax implication, transfer of shares between husband and wife will be at no gain, no loss. So if the husband's retiring and transferring the shares, whether or not my reading of the legislation, and it might be worth double checking this, but my reading of the legislation is that any transfer, and that includes a gift or an actual sale, any transfer between husband and wife will be at no gain, no loss, and therefore a straightforward sale. There will be no tax implications. Whether or not you're actually doing this in order to obtain the business asset disposal relief now, I think that basically means you can't. You could look at other options, but again, I don't think you'll get anywhere with those either. And I think it's that overriding section in the Capital Gains Act that's gonna be the sticking point in terms of trying to obtain business asset disposal relief. A company purchase of own shares won't work. The connection test is failed by the fact that a connected person continues to control the company, and I'm sort of 99% certain that HMRC wouldn't give clearance to a management buyout route either, for the same reason that they wouldn't accept transactions in securities, wouldn't apply, and therefore an income tax charge. So The short answer is, in terms of are there any tax implications, no. But if you're doing it purely to obtain business asset disposal relief, then I don't think that will work either. But yeah, happy to discuss that in a bit more detail if needs be.
Okay, lovely, thank you. And I think we've time for just one more question. What are warranties or indemnities?
Yeah, I'll pick that up. Okay, so I talked on the final slide in my section on the fourth pillar about getting to the point where we navigate the process through to what is known as a share purchase agreement, or SPA as it universally becomes known, or an asset purchase agreement, APA. Warranties and indemnities are less common in the case of an APA, but not unheard of. Certainly in the case of a share purchase agreement, the sellers will be called upon to provide warranties and indemnities, and these are basically legal undertakings to the buyer that, and I'm generalizing a bit here, but generally go to the issue of, we told you everything you need to know, we've held nothing back, and we haven't told you any fibs. Okay, so you're effectively representing to the buyer that, you know, they can take on the business as they understand it, and you've expressed it to them, and do so confident in the knowledge that if it turns out to be that you've hidden something, then they'll have some kind of legal recourse back to you. Now, there's a kind of counterweight, if you like, to the warranties and indemnities, which is, again, I don't want to get too legal here, but it's something called a disclosure letter. So the counterweight to the warranties and indemnities is part of the process. We, together with the lawyers advising you on the deal, will produce quite a lengthy disclosure letter, which will go to the issue of making sure that in case there's any doubt over the matter, we have told you everything you need to know. So take, for example, I don't know, we enter into warranties and indemnities that there are no outstanding litigation against your company that could come and bite them after the event of them buying the shares. Having made that statement, what we'll do together with your lawyer is sit down with you and say, I mean, is that true? Is there any risk? Has anybody threatened to sue you? Is there any event that's occurred in the near recent past that could give rise to litigation? If you say, oh yeah, there was one customer who queried something, and he indicated that if we didn't resolve this issue, he might sue us. Well, let's just disclose it. So we write it in the disclosure letter that there was a customer that said once he might, and that way it's disclosed. It's clear that there was a disclosure made, that we've assessed the risk, we regard it to be zero. If they want to look into it further, they're welcome to look at the documents relating and so forth. So we've disclosed it. So warranties and indemnities are part of that final completion process. A bit like every other aspect of the completion process, we'll guide you through that when we get there. We'll talk to you about it in a language that hopefully you'll understand. I'm not being disrespectful to my legal colleagues, but we'll talk to you about it in a language that you will understand, and we'll help guide you through the disclosure process to make sure that any risk involved is mitigated.
Okay, thank you. I think that's possibly all we have time for this morning, but if you have submitted a question, we will respond to you directly. Thank you.